Hello and welcome everybody. I'm Dr. Richard Smith, Chairman and President of the Foundation for the Study of Cycles. And I am absolutely delighted to be here today with Robert Prechter, a man who needs no introduction to this audience, but for those who might be new, Bob has been breaking new ground in markets with innovative theories for decades. Written 14 books, was president of the CMT at one point, member of Mensa, but really somebody who's brought us new insights into the markets over a lifetime of work, particularly around Elliott wave, but also a bigger picture too, and I'm looking forward to getting into that a bit today with you, Bob. So welcome, Bob. We're delighted to have you. And anything you want to start off with before we get into your presentation?
I'm ready to dive in when you are.
All right. Well, just a little preamble. We had a phenomenal meeting early last year. It was the spring of kind of 21, I think. I don't remember the exact date. But you made some bold calls, and those calls have turned out to be accurate so far. And the bold calls being a major top in 2021 in the stock market, a major bottom in interest rates, and also a bull market in commodities. And all those things have happened since we last. So looking forward to kind of reviewing how you made those calls and hearing what you're seeing today. So without further ado, please, let's get started and we'll follow up with some questions after your presentation.
First of all, I have to thank you for your timing. That was a big part of that.
Yeah.
So, all right, let's.
I did feel it coming.
Yeah, let's start from the beginning. My screen is up. Can you see it?
Yes, sir. Got it.
All right. This was last year's title, which is Regime Change. And I was looking for major turns in virtually every major financial market. And I'm going to just review the three major charts that we looked at that time. The first one is a time chart of the Dow Jones Industrial Average, which has been spliced to earlier data, which is courtesy of the Foundation for the Study of Cycles, by the way. Very, very helpful.
Yeah.
And I had observed for a number of years that 2021 was a culminating year in a Fibonacci progression of years. If you look at the bottom,
first put this chart together, Bob, back in the late 2000s, if I understand, right? This isn't something that you kind of backfitted to the data for 2021 in 2021.
No, that's true. Yeah, we've been looking at that for several years.
Yeah.
So just to recap, if you look at the line on the bottom, you can see that from the founding of the United States, 233 years, which is a Fibonacci number, brings you to 2021. And the 1932 low split that amount into a Fibonacci section, 144 years on the left side, 89 years on the right. The 144-year span that led up to 1932 low also was split into a Fibonacci section of 55 and 89, plus or minus 1 year. And from 1932, we had this beautiful progression of time, of a time sequence marking major turns. So from 1932, 34 years later was 1966. That was a major top in what we call cycle wave 3 in the bull market. 21 years later was the crash of 87, the top and crash of 87. 13 years later was the year 2000. And then when you count down 8, 5, 3, 2, 1, 1, you get to 2021. Now it's kind of interesting. You'll see all of them are precise, but one. We had a top in 2007 and a bottom in 2009, and the ideal year there was 2008. So I had to put, well, that's going to be plus or minus 1 year. And it turned out to lead us to 2022, the second trading day of the year. So it stretched out to 2022 just to satisfy that one last number.
The structure in this chart is absolutely unbelievable.
Yeah, it's very fun. And of course, our whole thesis is that Elliott waves are endogenously created. They're part of the human experience. People conform to them as well as produce them. And so once you recognize a progression that's occurring, you can get close to predicting what's possible.
So can I ask for just briefly, what is the connection between Elliott waves and Fibonacci?
Well, R.N. Elliott noticed that the stock market was progressing in 5 waves in the direction of the major trend and 3 waves against. And 5-3, of course, is a Fibonacci relationship.
numbers.
The total is 8, so that's another Fibonacci number along the sequence.
Okay.
And when he looked at the subdivisions of those waves, of course, they subdivided into 5s and 3s, which when compounded give you the entire Fibonacci sequence, 2, 3, 5, 8, 13, 21, and so on to infinity. And so it actually wasn't R.N. Elliott who realized there was a Fibonacci connection. It was Charles Collins, to whom Elliott sent his first work. And Collins said, I recognize these numbers. And that got R.N. Elliott all excited, and ultimately me as well.
I have to say it's heartening to see this kind of structure in markets and realize that it's not all just randomness and disorder, but that there is a natural structure. Very, very encouraging and very heartening.
Yeah, nor is it mechanistic. Economists work from a mechanistic paradigm. Well, something will have to happen. The Fed will make an action, or there'll be a law passed and it's going to change everything. And our thesis is no, it's not going to change anything. Rather, these waves more or less regulate what kind of events are going to occur.
Incredible.
Yeah, it's cool. Okay, so that was our stock market chart. We were arguing, look, 2021 should be the final up year in this extremely long sequence. I think we got that because the broad market peaked in November, and then the blue chips peaked a couple days into January. So let's go on to the next major paradigm shift we were looking for, and that was in interest rates. And this was the chart we showed last year. And from the low in 1942, when the 10-year Treasury note yielded 2%, there were 39 years of rising rates, peaking out in 1981. Well, we had just noticed that after 39 years of falling rates had apparently reached a bottom in 2020, when the 10-year note yielded only 1/2 of 1%. So 39 years up, 39 years down looked like a complete cycle. Now, that's not necessarily guaranteed, but what did we have going for us? We had negative interest rates in many places around the world. It's absolutely unprecedented. I think it was unpredictable. I can't imagine anybody making a case for why rates would ever go negative. But we actually had that, and economists were saying, oh, this is going to be with us for many, many years. It's a shift in the way things work. And we said, no, this is historically ridiculous and an extreme. And it's going to change, and we're going to get back into a more normal shift. So that was the prediction for rates last year, rising for a long time from an extreme low. And the last chart we reviewed, or the last major area that we reviewed, was commodity prices. And this is our long-term chart of commodities. I think we had a beautiful Elliott wave from the 1933 low in the CRB index all the way up to the peak. And if you study the internals, they're absolutely beautiful. You get 5 waves within 5 waves and 3 wave structures on the downside to correct them. And then we had this stunningly huge bear market from the peak all the way down to a low in 2020. And we noted at the time that it was a 78.6% decline, which happens to be—
And this is commodity prices.
Yes.
Yes.
It's amazing that an index can do this, but
it is amazing.
Absolutely.
And if anybody wants more detail on these charts, Bob covered them in depth in our previous interview, which is available for free at the YouTube channel for the Foundation for the Study of Cycles.
Okay, so The down 78.6% was a real bell ringer for us because that happens to be the square root of 0.618 or so. I mean, it was a beautiful structure. We had our ABC, we had 5 waves within C, and we said that this is going to be a paradigm shift away from sort of an easy environment where things were cheap and plentiful, and that was going to change. Now, before we go on to, seeing what's happened since, I thought we'd take a little side trip and look at a few more Fibonacci time and price relationships that have occurred in the stock market. This is one of my favorites. I just wrote this up for the latest issue of the Elliott Wave Theorist, and I noticed that of the 5 major waves from the 1932 low, the time element was extremely interesting and also related to Fibonacci multiples. You can see that the note at the bottom says that these years are all multiples of 8. So the corrective process from 1966 to 1982, right there in the middle, was 16 years, and that's twice 8. The rise from 1942 to 1966 was 24 years, that's 3 times 8. The big 5th wave from 1982 to 2022 was 40 years, that's 5 times 8.
Wow.
And the first 2 waves of 5 years apiece were 0.625, which is a Fibonacci ratio. So you've got 2, 3, 5, 8, which is the Fibonacci sequence, and all of these waves are related in time by Fibonacci as well. And keep in mind, this is on top of those Fibonacci structures that we studied in the first chart. So you not only had the progression reaching the final 233-year culmination, but you had all the components following a Fibonacci relationship. And I'm just going to show you the same waves, the impulses this time, the rising waves, and how they're related in terms of price. These are pretty cool multiples. From the low to the high of each wave, the first one was a 5/3 cubed multiple, and the middle advance was an 8/5 to the 5th power multiple, and the final one was 13/8 to the 8th power multiple. So you can see how all of the numbers involved progress 1 Fibonacci number upward. They're all within 2% leeway, which I consider rather large. But we also have a slew of other charts that are much more precise showing these things. But this is the coolest in terms of the ratio progression. We also had something a little more simple that most people could probably see if they looked, and that is from the 2009 low to the 2022 high in the Dow Jones Industrial Average. The crash low of 2020, a lot of people call it the COVID crash low, split the entire rise into a Fibonacci section at 0.60, or 60% of the rise followed that, and 0.40 preceded it. The S&P was almost the same, but slightly different. It was much closer to the actual Fibonacci ratio of 0.618. So we had 0.62 split versus 0.38. Again, all those things are happening at the same time, which I find really interesting. So those kind of things told me, the fat lady might be singing here at the end of 2021 and early 2022.
I was wondering where you were going with this image here.
Yeah, I did have to explain that one.
Yeah.
Okay, so what was going on in 2021 in terms of investor psychology? And I'm going to show just a few charts. In December 2021, which is the final month of rise, I put out an issue of the Elliott Wave Theorist, and I said, this is a major peak environment in terms of market sentiment. So let's just review a few. I showed 27 charts in that issue, but we're only going to look at a few of them just to give you the flavor. Now, here's an indicator that goes back well over 100 years and shows 5 of the greatest investment overvaluations of that entire period. The last one, the one that we were living through, we called the everything peak because it was not only the stock market, but it was also real estate. It was crypto coins. It was junk bonds. Everything imaginable was being bid way beyond normal valuations. And this, of course, is based on several things grouped together: the gross domestic product as it relates to stock prices, stock prices compared to corporate sales, corporate earnings, corporate book value, all put together in one indicator. So that was extreme, historically extreme. And here are two more that we paired, showing that the market was trading at 3 times corporate sales. And if you look back at the 2000 high and the 2007 high, which led to the biggest collapse since 1929-32, the average there was 2 times corporate sales, and we were well above 3 times. On the right side, you can see that we were trading at twice the quarterly US economy. And again, looking back at 2000 and 2007, that was nearly double of the average of those 2 peaks. So extreme valuations on those measures. One thing that was helping all the buying, of course, was people borrowing money to do it. So we showed this chart as well of record margin debt in 2021. And the previous times where the red arrows are were times when margin debt peaked almost coincidentally with the stock market. Usually it peaks a little bit early, a month or 2 early. And I
So
think
the
that's
right
what
edge
happened.
on this chart is around 2020.
Pardon?
Is the right edge on this chart around 2020?
We published this particular chart in January 2021. So yeah,
Okay.
that was through December of 2020.
Okay, wow.
And it did go a little bit higher from that point. But it
Isn't
shows
it
you
incredible that the media
fuel
wasn't,
was.
isn't it incredible the media wasn't talking about this at
Oh,
all
no.
during this
It-
time, and everybody believed this time was different once again?
Well, everything feels normal after a while. So they say,
Mhm.
yeah, this is normal. You know, these crazy valuations are normal. It's just the way the world works. And if it didn't, it couldn't possibly operate. The Elliott wave model couldn't possibly accurately describe what's going on unless people participated. And they do it. It's a crowd psychology situation, and nobody ever can see what they're doing. Human beings evolved to participate in crowds, not recognize them. Okay. Oh, this was another chart that I really liked. People
I just
were
want to put a pin in that for a second. Human beings evolved to participate in crowd behavior, not to, what did you say, see it? Not to recognize it?
recognize it, analyze it, understand where they were within it. Well, this is the flip side of the mania for stocks and all kinds of other assets as well. And that is that people thought cash was absolutely not worth holding. So the money market ratio, the amount of money that public had in money and money equivalents, was the lowest ever recorded. And that was down to 2%. We'd never seen anything like it.
Mm-hmm.
Mutual fund cash was also at a record low. Previously, a 4% reading was an extremely low reading, and even this got down to 2%. Mutual funds, of course, are managed by people that own stock, but most of the time they want to keep some cash on hand in case they see some more values that they want to pick up.
Mm-hmm.
But in 2021, they just said, we can't imagine the market going down enough to make us want to buy stock later. We want to own it right now. And they did.
Mm.
And the IPOs were at a record. This shows the 2020 record. They were also extreme in 2021. People couldn't get enough stock. So Wall Street obliged, and they came out with all kinds of companies and throwing new shares on the market. And every time they did it, people just rushed to own them. We're going to see how that turned out in a moment. This was a headline from October 2021 that I thought pretty much captured the psychology. Wall Street stock analysts echo crypto bulls in seeing nothing but gains ahead. Nothing but gains ahead. Now that's a pretty classic summary of how people feel at tops.
Mm-hmm.
Well, today it's a different world, and that's what we're going to talk about next. So that's where we were in 21. Where are we now? Well, Bitcoin is down 70% from its high on November 8th, 2021. That's a pretty big decline.
Mm-hmm.
And of course, crypto coins were extremely popular. We had celebrities touting them, you know, in the final months of the rise. It was really incredible. But 70% down is a pretty serious decline. The Dow Jones Industrial Average has fallen 22%. from its high in the first couple of days of January. S&P down 26% from its high on the 4th of January. The NASDAQ composite down 35% from its high, and the NASDAQ couldn't hold up till January. It topped in November, along with most of the broad market indexes.
Mm-hmm.
And what about those IPOs? We just looked at an IPO chart. IPO stocks have tumbled, according to the Wall Street Journal, hobbling demand for new listings. So the new listings are also down because people only want to buy them when they think they're going to go straight up. And here's a little summary. About 87% of companies that went public last year are trading below their IPO prices. So the prices have fallen. People have realized, oh, it's not free money after all, which is what I thought. And so the new listings have fallen off. So that's part of the new world as well. Okay, what about interest rates? They certainly have changed. There's something new going on there as well. This is a chart of the 10-year Treasury note from its low in 2020. The yield is up 1,200% from that low. Of course, bonds that had negative yields are up an infinite amount from their lows. And of course, from the low in mid-2021, they've continued to climb. So that's changed. Junk bond prices are down 15%. So that has changed. People were so complacent, so optimistic in the 233rd year of this giant rise that they were willing to buy bonds of companies that were very close to bankruptcy and perfectly happy to do it and only earning a little bit more than US Treasuries were paying. It was an amazing, amazing time. And now
everything's going up.
Now they're starting to pay for that optimism. And of course, finally, we've had a strong rise in commodities, a very big jump there with, I think, room to go. If commodities want to continue to go up, they certainly can. There'll be pullbacks along the way. That was an extremely sharp move up off the bottom. So we can.
So this is actually a current chart here into 2022.
This is updated, right? Yeah.
Mm-hmm.
Okay. Now, the question that I'd like to address for the rest of this time is, has the new regime run its course? Because, I mean, according to Wall Street, 20% down is a bear market. So some people think, well, the Dow's already had a bear market. Junk bonds have almost had one. They're getting close. Certainly the cryptos have had one. They've wiped out a number of companies. So is that enough? My answer is no, not even close. And I'm going to show you some charts that imply that there's plenty of room on the downside. This shows Bitcoin from its inception. Not many people know that Bitcoin started at a penny. And in fact, my son, Elliott Prechter, wrote up Bitcoin for the Elliott Wave Theorists back when it was 6 cents. We put out a 3-page article on Bitcoin and said, this could be a new currency. Wow. This is a brand new thing. But this investment vehicle, if that's what you want to call it, went up 7 million times. Yep. I don't think anything has come remotely close to having done that in the history of investments.
In just 12 years.
$70,000 a coin. That is unbelievable. So yes, it's down 70%, but I think there's plenty of room to go lower if it wants to. Mm-hmm. The Dow has risen 60 times, or let's say rose 60 times up until 2022 from its 1974 low. That's a lot. And the 20% decline that we've seen is barely a blip on the chart. So again, there's room on the downside. We're going to talk in a minute about, why I don't think that's a low, even though it sort of looks like some of the pullbacks we've already had.
And that's a log scale chart, right?
Yes. The S&P rose over 75 times in price from its 1974 low. There's plenty of room there. The NASDAQ composite rose nearly 300 times in price from its low in the early 1970s, and that certainly has plenty of room to fall as well. I think interest rates had plenty of room to rise. This is the same chart we looked at from last year, but now updated. And you can see on the bottom left, we've had a pretty good rise in rates. On a percentage basis, it's a huge rise in rates, 1,200%. on the
Right.
10-year note. But there again, there's plenty of room to go higher if the market wants to take them higher. Junk bonds, as we showed earlier, are down 15%. But when you put it in perspective relative to where they were in 2008, again, this is a logs chart, there's plenty of room for junk bond prices to fall as well. I think it's going to take a while, but junk bonds will probably be selling at quite a premium over treasury rates sometime in the next 2 or 3 years.
Mm-hmm.
All right, now what we've talked about so far is there is room for these markets to go further, but someone could easily say, well, look, the stock market's down 20%, 25%, 30% in various indexes. That's plenty. Why wouldn't it just stop right now? And I'm going to show you a couple reasons why I think it's not likely to do that. This is a picture of the year-end valuation of the S&P 500 or industrials on the other axis, as measured by two valuation readings. One is the dividend yield from the S&P 500, that's on the x-axis at the bottom.
Okay.
And the other is a multiple of book value. That's the vertical axis, the y-axis on the left. And for most of the 20th century, from 1927, when our data begins, through 1987, there were only 5 times when the market was valued something outside this box. And 4 of them were below the box, meaning they were valued even lower. So
Okay.
this is
Are
what I
those
would call
outliers on this chart or not?
No,
Because I don't see
didn't show them,
dots
but
outside the box.
you'll see them soon.
Okay. So just to be clear for everyone, like on the horizontal axis, a higher yield is closer to the left. So
Yes.
that would be a overvalued situation. And as you go further out to the right, when the yield gets lower, that's undervalued.
No, to the
Or is it
left
the other way
is
around?
undervalued because
Okay, right.
yeah, they're
Because it's a
paying
higher yield.
7%
So,
yield. Yeah.
right. Okay. So it's,
So
and then going up, you're looking at the price to book value. So obviously higher is more overvalued.
that is correct.
Okay.
Actually, I'm glad you brought that up because when I redo this chart, I'm going to slide the word undervaluation to the left and overvaluation to the right above the box.
Yes.
That's where they should
Okay.
be.
Very good.
So I'm glad you clarified. Thank you for that.
Hmm.
And even though our data stopped in 1927 going backwards, I'm pretty sure that most of the previous century would be inside the very same box. That essentially stocks, sold at around 1 times book and, somewhere between 3 and 7% yield.
And
All
this
right,
is
now
only
I'm-
for the 1927 to 1987 that we're looking at here.
Sorry?
This is only 1927 to 1987.
That is correct.
Okay.
Yeah. And what we're going to see next is what the stock market has been doing ever since 1987 in terms of valuation.
I'm scared.
You should be. You should be. And here we go.
Oh,
Can you find the box? Yeah.
Oh my goodness. That is sobering.
Yeah,
I
the
wasn't
normal
prepared
box
for
is
that.
way down.
I wasn't prepared for that.
And look at the top right, where I
Oh,
have a little dot in the year 2021. That
Oh,
was the
no.
year-end valuation in 2021.
oh no.
One of the lowest dividend yields ever, not the lowest, the lowest was in 2000, but in 99 and 98, but very, very low yield from dividends. And the highest multiple of book value ever recorded at year end, which is 7 times book. So do I think this bear market is over? Not even close. I think that these valuations are both going to at least come back into the normal area. And as many, well, let's say several old time technicians from the 30s and 40s said and noted, when a market gets too far on one side, it usually will go too far on the other side when it comes back. So I think we're going to see undervaluation probably in the next few years when this bear market is finally over. So that's some perspective on how much room there really is for the stock market to get back to a normal valuation.
Or I want to go out and dig my bunker now.
Oh, no, you don't have to do that. We'll talk about, I mean, you can really just get out your lounger and put your feet up out in the sun because there's a way to avoid all this difficulty.
All right. Well, that's a promise if I ever heard one.
Well, it's pretty simple when you see it.
Okay.
Although
did you make this chart yourself?
Pardon?
Did you make this
yeah.
chart yourself?
Yeah.
That is one of the most incredible charts I've ever seen. Thank you for that.
I love it. We call it the Pluto chart because the
great name for it.
Outside the solar system. It's amazing.
Oh my goodness.
All right. Let's focus only on the x-axis now and look at dividend yield going back 100 years. So we got the Dow on top, and underneath it we have the Dow's dividend yield. It's an annualized dividend yield, I think month by month, if I recall. And look at the spike that happened over on the left side at the bottom in 1932. The Dow, people were so scared, and they undervalued stocks so deeply that you could earn 17% very briefly on your stocks at the low in 1932. But the level I want you to really focus on is the one at the 1929 high. And you'll see a low in yield of 2.83% there. I considered that a benchmark. That was the most overvalued market in terms of yield we'd seen through all the way up until the late 80s. It briefly dipped below that yield at the 1987 high. And then starting in the mid 1990s, you can see that it persistently remained below the lowest yield at the top minute of the stock market in 1929. And it's done so for 27 out of 28 years.
So I got to stop you here for a second because this really is mind-boggling. We should not have seen it below the 1929 level. And yet, not only did it go below, which you might have thought maybe that was a buy signal at that point, but it stayed below practically for 27 years and it's still well below. So do you have a thesis of how that happened and what's changing now that is going to, finally rectify this really, abnormal situation?
I definitely do. If you look toward the left side of the chart at the high in 1929, you'll see a 3 in parenthesis.
Yep.
That means that top was super cycle wave 3.
Okay.
Pardon our jargon, but that's what we call these very large waves. Super cycle wave 4 bottom in 1932, and we've been in wave 5 ever since. Fifth waves always reach a higher valuation than third waves. I was fooled for years because I couldn't imagine it going on as long as it did. When the yield fell to 1.4% in 2000, as you can see on this chart, I mean, I thought that is absolutely it. We can't possibly hold up any more than this. That's got to be one for the record books. It was one for the record books. And in fact, in 1999, we recorded the highest valuation of stocks in terms of gold, in terms of real money. It's never been exceeded. And so all of the last waves were all part of a funny money environment. But still, the valuations were extremely low and people kept them there. And that's the key thing. So we've had decades of just absurd values that people have come to accept as normal. I think we're going to start seeing dividend yields rise. And one reason is they're going to have to compete with interest rates, which are also rising. So we are in a new paradigm here, I'm sure of it. Okay, this is the last chart I'm going to show. And I think it's the most important chart here for people who are going to plan their lives going forward.
This is the put your feet up on the lounge chair chart?
No, that was not part of my presentation, but if you want to talk about what to do after we look at all these charts,
absolutely. Okay.
I've never seen this chart before, but it's a ratio, elsewhere. It's a ratio of the the Dow divided by the CRB index.
Makes
In other
sense.
words,
Yep.
how many baskets of commodities is the Dow worth, according to human brains in the aggregate?
Yep.
Well, the low was hit in early, I think it was 1922, down there in the bottom left.
Okay.
It was less than one. People valued things at that time far more than they ever thought of valuing stocks. And
Right.
for all
Financials
the
versus
years,
things.
yeah. So here we are a century later. The peak in the ratio occurred in 2020. It's starting to come down. And I think, I mean, I was stunned. I had to check the data over and over to make sure it was correct, but there was a 200 times multiple in how people valued stocks versus how they valued commodities from the 1922 low all the way up to 2020. So stocks are absurdly overvalued relative to things. And I think the future that we are facing, and it's going to last decades, is going to be a shift away from valuing stocks really highly and toward valuing things really highly. And this is not only showing up in an advance in commodity prices, which isn't even necessary. We're also seeing it in shortages of various goods and sometimes services as well. It's hard to get parts. Every now and then you go to the store, well, we don't carry that anymore.
Yep.
They're out of certain foodstuffs on occasion. We've had warnings about the supply chain.
Yep.
So I think all of those things are combining. We're definitely, in my view anyway, going to have falling stock prices. Commodity prices, I think, are arguable. They're more likely to go up than down, but they don't have to. The main dynamic here, I think, is going to be falling stock prices. And we talked about that lounge chair thing. In January, I put out 3 books, or I finished 3 books.
Okay.
I mean,
Wow.
they're not huge books, you know, they're 100 and something pages or whatever on average. One of them is detailing all of the indications of a top that we reviewed earlier here, or some of which we reviewed earlier here. That's called Last Call, summarizes all the arguments. It's an outlook for the bear market as the middle book, all the things we wrote leading up there saying, here's what to expect when the bear market starts. And the one on the right is the book that tells you what to do if you want to stay safe. And, you know, during our chat, we can talk about some things that people can do in order to stay safe. I don't think you have to worry very much. There's some really terrific options for people who do not want to participate in the stock market, the bond market, the real estate market, crypto coins, or any of the things that have been popular. And now that we're in a new regime change, it's going to be cash that is popular. So if you've got some, people are going to want it from you and they're going to pay you to access it. And that's the way you get around it.
Well,
so that's it. That summarizes my my comments.
So these books are available at elliottwave.com. Yes?
Yeah, /books. If you go to /books, you see all the books, and they're bundled. So, you know, if people want them all, they can save some money. And we also offer them for no charge at all if you get a 1-year subscription. So
are there any other places that people need to know about to pursue your work, or is elliottwave.com your primary destination right now?
Yeah, elliottwave.com, definitely if you're interested in our financial work. If you're interested in sort of broad theoretical things, we have a website called socionomics.net. And that's,
okay.
You know, that's fascinating. It covers things like cultural trends and politics and things that are ebbing and flowing with these waves of social mood that we think are determining where the stock market is going. So that's kind of fun.
Yes, I'd like to talk about it a little bit too, but before we get there, why don't we stop sharing your screen and talk a little bit about what people, you know, what you think the right way to live is in this regime change era. So I'd love to hear your thoughts.
Well, you know, bear markets are really tricky to trade, and very seasoned traders can deal with them. They have extremely sharp rallies. And just when you think, oh, my account's really going to be great, you know, 2 weeks from now, that's when it'll stage a really sharp rally. And it's fine. Yeah. I think people should play the downside if they can. That's what we spend our time doing, is analyzing where we are in the wave structure on the downside. But most people aren't built for that. so that's why I wrote Conquer the Crash. And I said, what should you do? And I have 3 or 4 recommendations. And my favorite is something that almost nobody knows about. And they're called floating rate notes, FRNs. They're issued by the US Treasury. They're good for 2 years, but you're not locked into an interest rate of 2 years. They reset their rate every week according to the 13-week Treasury bill.
Mm-hmm.
And they have been going from nearly zero back in, what was it, June, I guess, to about 3.5% right now, and still rising.
Mm-hmm.
And every week they reset that rate. So you follow the interest rate trend all the way up, and they pay you the current rate all the way up.
Wow.
And other bonds lock you in, and if rates keep rising, you get a capital loss, and you're locking in a low rate, and you're
Mm-hmm.
sitting there stuck in a 2% yielding note or a 3% yielding note when they go to
Right.
6% and 8% and 12%. And you're wondering, what in the world have I done?
Mm-hmm.
And you can't get out unless you take a capital loss. This takes care of that. And
You
there's
get
even
those
a
from
slight rate.
treasury.gov?
Yep, you can read about it, treasury.gov. Just type in floating rate notes. I think it's page 134 in my book where I discuss them. So if you want to learn about it there and Conquer the Crash, you can do that. And, I've got a few other recommendations, places where I think would be a good idea to have some money offshore in a bank that isn't overseen by our local Fed. So I've got some leads there for people. If you have hard money, if you have gold and silver, I found a unique storage vault offshore as well. A very safe place. And my feeling is, if you ever had to leave the country, not that I'm thinking you have to, but if you ever did, you have a plan B, it's nice to have some assets somewhere else.
Okay, and this
can
is
access.
all
So
in your
that's sort of
updated
the more or less
edition. This is all in
Right.
your updated edition of Conquer the Crash?
Yeah, we call it Last Chance to Conquer the Crash.
Last chance. All right.
Because, the previous decline, even though it looked crashy at the time in 2008, wasn't the big one.
Mm-hmm.
As I thought it was developing into at the time. And when we finally got into 2021, I said, okay, they just wanted me to get old before they started on the downside.
Is there anything that you are paying attention to that you think would be a sign that somehow this isn't the big one either? Right? Like maybe an action of central banks, or
Well,
or
if
is
I
it just
retire,
out of everybody's hands at this point?
I have no alternate counts on long term.
Mm-hmm.
So
Okay.
if I'm wrong, I'm just wrong. And to your direct question, no, the Fed can't do anything about it. The Fed is going to be a victim of this thing as much as everyone else. They already are starting to look incompetent, and people are starting to get angry at them.
Yeah.
And what's fascinating is they're not doing anything. The Fed doesn't set any interest rate policy. They do set monetary policy when they agree to print more money to accommodate the government.
Mm-hmm.
So that is something they have control over. They could say, no, we're not going to do that this time. But in interest rates, they have zero power. We have charts going back to the inception of the Fed showing that what the Fed has done, what it's still doing today, what it will always do is simply follow the market rate. It follows the Treasury bill rate with an average 5-month lag, and they're still doing it. So they're saying, oh, the Fed is making a big decision. Are they going to raise it 1/2 or 3/4?
Right.
Well, they have to raise them because market rates have gone up. They're simply following the market rate. It's all they ever do. So they are being manipulated by the waves, not vice versa.
And my personal opinion is that those events are primarily churn related events for kind of the trading and media aspects of financial markets, right? They're big events. Everybody's tuned into Bloomberg. The traders get volatility, and the media gets eyeballs. And that's primarily what these announcements are.
Yeah.
What do you think?
And well, the default in the human mind is physics. We survive by understanding a lot about physics. Like when one caveman threw a rock at another, he knew that the trajectory wasn't going to change, so he could duck and get out of the way. So our minds default to that. We think, things need a physical cause. And that's true for many aspects of human life in the world,
Yes.
but not in finance. In finance,
Well,
it's endogenously regulated. Outside events have no effect whatsoever, except on an extremely short-term basis. As you said, volatility can increase very often on some of these announcements. Sometimes it doesn't. It shows you it's not universal. And then people therefore think, oh my gosh, the market's jumping around. The Fed is causing a big change. But if you go back, in fact, the first couple chapters in my book, Socioeconomic Theory of Finance, I show that you cannot pick out on the chart where Fed announcements occur. They're in the middle of trends. They're sometimes near the ends of trends. They don't predict anything except short volatility for maybe a few minutes to a couple hours. That's it. They don't
I'm so
change
glad
the
you
day.
brought this up, because I think this is a really important issue. A friend of mine put it one way. He said, culture is downstream from physics today, right?
Oh,
You know, there's a famous saying that politics is downstream of culture. I think it was Andrew Breitbart, but then my friend said, culture is downstream from physics. So we do live in this physics-induced culture where we're always looking for cause and effect in a mechanistic way, right? So the Fed says something and that causes something. And we're all kind of living in that narrative that we live in a physics world, right? That the
yeah.
world is run by physics.
Yeah.
And I personally believe a very problematic view of the world that's leading us into some difficult places, not only economically, but even emotionally and even spiritually. So one of the things that I've really come to appreciate more about your work, that I have to admit I didn't fully appreciate until I really started looking at your socioeconomics work, is that you really do have an alternative theory, an alternative framework to this kind of physics mechanism view of the world that I think has kind of run its course, gone too far, and also is really allowing a very small group of people to control narrative in a way that isn't justified and is kind of exacerbating some of the problems and some of the divides between even the haves and the have-nots in our world today. So love to hear your thoughts on that, and a little more about socioeconomics as kind of an alternative to a physical understanding of economics.
Yeah, the belief in outside causality causes a lot of problems, and that tends to make things worse. People say, well, if we pass a law forcing X, that will improve the economy, and it never does. It usually makes it worse. And it's funny that the timing of those things is usually during the period when you're suffering already. So they come
Right.
along to make things worse. Yeah, it's an aspect. People try to apply economics to finance. And one of the big arguments in my book is they're completely different fields. There's no such field as macroeconomics. There is microeconomics, which is proper economics. But everything else is regulated by waves of social mood, which people regulate unconsciously on their own in the aggregate. And if you can follow and read those waves, you're much better off than somebody who's looking for the next cause.
And is there any basis for a kind of causality within a wave-based world, right? Or is it just, hey, a few of us can see the waves and position ourselves to not suffer as much as everybody else? Or is there something that we can learn from these waves and respond to, you know, societally or culturally?
That's a good question. I think individuals can improve their lives by observing waves and changing certain aspects of what they do. I mean, one of the classic things I always point to is everybody was building bomb shelters in the 50s. Why? Because we just had a war and we were in the middle of a bearish period, or we just come out of a bearish period. So people were preparing for the past that was already behind us. So when you get to periods of euphoria, nobody has any bomb shelters, militaries are all slack. And you know that a few years later is when wars are likely to break out. So people are preparing for the past instead of the future. If you can look at Elliott waves and say, well, I can probabilistically sort of anticipate some of the things that might happen, you can get ahead of the curve. I've been too far ahead of the curve. I've been sitting in these FRNs for a number of years now, waiting for rates to finally roll around. So it's nice to see them finally do that. It took a long time, but I'm happier, I think, than if I had been overinvested in stocks and cryptos and watched them go down between 20 and 70%. I think it'd be very scary. So yeah, there are things you could do as an individual, but people say, well, you know, why don't you go teach the president or Congress this? It's like, it's impossible. Theoretically, it's possible for an individual such as a leader of a country to understand this kind of thing. It's unlikely ever to occur, but you definitely cannot convince a group, because groups share their psychology and create waves. They live them and create them. They don't sit outside and analyze them.
And just a little bit of meta theory here. So these waves, where did they, like, I was reading at one point some of the work of Wayne Parker, right, who is has written some chapters in your book here, your very big book, The Socioeconomic Theory of Finance. And I guess you've got a few of these books on socioeconomics that are equally as big. But
yeah, for this audience, that's the main one.
Good. And so, you know, it's like, where do these waves come from, right? So you said they're not Platonic, meaning they're not kind of like forms that are out there that kind of pre-exist the actual instances of the waves themselves. So can you just say a little bit about kind of what you think, how we should really understand these waves, what they are? And they're not a mechanism per se in the same sense of physics. So what are they?
Yeah, Wayne was brilliant, and he wrote a PhD thesis on meta theory based on the ideas of a man named Pepper, and he who recognized 4 different ways of approaching the world. He said none of them are necessarily wrong or right. He said they're just different ways that people view how the world works, and mechanism is one of them. Formalism, which is the Platonic idea, is another, that the forms exist in some ethereal space and then things can form. But the other two are organicism and contextualism. And it seems that the wave principle model, the idea of the wave principle and the way it works, fits into the latter 2 categories, so that the causality is holistic. It's not mechanistic from one billiard ball to another. You've got the individuals involved, those are individual people, and their interactions are sort of creating the Elliott waves in one sense. At the same time, the Elliott waves are the form to which they are conforming. And so you've got both top down, the form is going to be satisfied no matter what. And you've got the bottom up, which the mechanists like to say, well, that's got to be the only side of it. But no, the waves seem to be the structure that way to which human beings conform. So it's a holistic causal situation. It is not from one side or the other.
And that is both organicism and contextualism together.
Yeah.
Interesting. So it's both a bottom up and a top down paradigm.
Yeah. In other words, if there were no context, you wouldn't have waves. If you have one person on a desert island, there would be no groups to create psychological changes mood changes among. So you need the human social context to start with. And then you can see the organs, that is the individuals, fitting into the whole, which is the overall structure.
Very nice. Well, Bob.
Yeah, it took me a long time to get my head around that, I have to say.
Yeah.
But it was revelatory, and it's sad to say Wayne's not with us anymore.
I saw that he passed away far too young.
Yeah, he really did. But yeah, he wrote some fascinating stuff, and that's why I kept him in the book.
Good. Well, I appreciate you sharing that with us. I do think it's important that we look at our meta theories, right? And we understand, even if we still believe in a kind of physics-based billiard ball view of finance, we should at least acknowledge that that's our model that we're working with, right? And it's very important to understand kind of the origins of our models because the models are never reality itself. They're models.
Yeah,
And
Matt Lampert, who now heads the Socioeconomic Institute, attended a conference in Paris one time with all these top academics, and there was one guy there who received something like $500 million from the government of France to run experiments on why markets do what they do. And so he had, of course, had a model of external cause. Well, when rates are doing this, what happens? And when this policy is in place, what happens? And so Matt said to him, so is that is that the way you think the world works? And he said, of course, what other way is there?
Right.
So that's what we're facing.
Yes, couldn't have said it better. Exactly.
Yeah. So all that money is going to complete waste.
Yeah.
Yeah.
Absolutely. Well, Bob, we thank you so much for your time today, but thank you for all your work.
Just, you want to have some fun?
Absolutely.
Let's look at the inverse. If people applied an endogenous causality to rocks flying through the air.
Okay.
That would be
so
wrong.
Let's explain what endogenous causality means.
Okay, so the rock can decide to change course. And
Right.
that would be silly. It wouldn't fit. It's the wrong causal paradigm. Well, they're applying that causality to a paradigm where it doesn't apply. Human beings have minds. They do make decisions.
Yes,
they
and
change from within, and they're trying to imply that it's all physics, like billiard balls. Billiard balls don't have brains. Humans do.
yes, and mind is different than brain, right?
Yes.
And there's a question about, does mind emerge from brain, or is mind something that's distinct from brain? Certainly the mechanistic paradigm that we're living in, where it's all bottom up, assumes that everything is essentially computational, and that mind does emerge, quote unquote, from brain, and that it is all billiard balls. It's just too complex for us to figure it out, right?
I suppose, and I don't think I'll join that conversation, but I will point out that mechanists never always have to go backwards in infinity.
Yeah, absolutely.
And then it's like, oh, well, if that causes it, what caused that? Well, this. Well, what caused that? And so on. In a holistic system as we have here, that's not an issue.
And I think that this is a really important point, because it's true. Like when you throw a bunch of rocks up in the air, they don't change direction, right? So there really is something to a mechanistic, physics-based view of the world. It's very powerful, but it doesn't give us a complete picture of what it means to be a human being making decisions in the world, right?
It does
and
not,
so there,
it does not apply to aggregate human behavior, that's for sure.
It doesn't apply to
either.
Exactly. So there's something else, whatever you believe its origins are, it's something that can't be addressed by the physics mechanism-based approach to problem solving. And so we have to figure out other ways. We have to commit resources to figuring out other strategies for ultimately solving some problems that we've got that can't be solved by a physics-based approach to problem solving.
Yeah, for what it's worth, I think social problems are best addressed by leaving people alone to associate with one another voluntarily, and that may not give you a perfect outcome, but it will give you absolutely the best outcome possible. But that's a whole other discussion.
Okay.
I touch on it very briefly in one of my chapters in there on Austrian economics. But
in the socioeconomics book?
Yeah.
On finance? Okay.
Yeah.
Great. Well, fantastic. Thank you again, Bob. It was really great spending time with you. Thank you on behalf
very
of
fun.
Foundation members, and thank you for all the work you've contributed over the decades. Fantastic.
Well, I'd like to thank you for reviving the Foundation for the Study of Cycles, bringing it back to, I would say, an intellectual plane that it hadn't seen for a long, long time.
Thank you.
You got a great group. You've got a great bunch of people who started it all. And personally, I really, I sometimes speak to groups that really don't study markets, and so I have to speak at a very superficial level.
Yeah.
But with your guys, your group, it's different. So thanks for the opportunity. I appreciate it.
Appreciate that. All right. Well, take care. See you again soon.
Okay.